Oh, Don, you just woke up. Very good. So anyway, you're doing right thing on the day morning on the weekend. Great. Let's see how best we can pick up some of the ideas of the accounting. Just give me a minute. I need to now share my desktop, and I think there's so many things which I have to do now. Give me a minute. I just keep my chat box open so that okay, we have two cases. The first case is about on this company called RA Agro. People from India might be familiar with this company, but not sure about others. This is a company which is actually dealing with basmati rice. Basmati rice is a special variety of rice which gives a lot of flavor, and there are a good amount of volume is exported from India. This company is one of the companies which is procuring the rice and then packing it and then exporting it. The rice also requires a time gap. Basically, the process is that it has to be kept for a while before they get adequate flavor. That's one. The peculiar requirement for this product is that it cannot be sold immediately on harvest. In the sense that you don't get the flavor. It cannot be used rather than sold. It can be sold, but it cannot be used immediately to get the right flavor. So you need to wait for a few months before you do that one. So that's the peculiarity of this industry. We need to keep it in mind. Now, the story about this company is pretty good. This company was doing well in the period which we are discussing. And you would have, hopefully you would have gone through this material. So they also talk about the high working capital requirement for the industry, and everything is there. But the question, the case issue is that someone is looking for investing money in the company in the form of a non-convertible debentures. There's also a rating available. Some company has given a rating. So the rating also seems to be okay. There's the whole analysis on the rating. But the discomfort in the whole analysis is that the revenues are increasing. If you look into that, 957 has increased to 1083. Then it has increased to 1732, increased 2446, and again 3692. So there's a good amount of growth is happening on the revenue side. Profit also to some extent reflect not going with this figure, but it's a healthy. These numbers are good. But the trouble is this one, cash flow from operating activities. So the cash flow from operating activity tells simply how much of the cash you collected from your customers and how much of a cash you are paying for your suppliers and other service providers related to operations, and what is the net cash generated through operations. When you look into that, this number is actually a negative and also increasing. For example, if you look into the 2009-10, you get an idea that the profit is increased from 95 to 241, which is a pretty healthy number, right? It increases about 2.5 times. But when you look into that, cash flow from operating activity is negative 293, and it has again gone to 764. The case setting is that this particular girl who is trying to help his father to take an investment decision, particularly it's a lending decision basically. She is a bit disturbed of the two items. The first one is related to the level of a debt, which is almost equal to 5 times more than the shareholders fund. the company is heavily levered, right? The loans is also already very high. If you look into that, 4,446 against a shareholders fund of 900. And the second concern is that the cash flow from operating activities was negative for all 5 years. Therefore, she was in a dilemma whether to go by the profitability of the company or a cash flow statement, while recommending to her father whether to subscribe to the non-convertible debenture or not. So that's a basic issue on that one. What is that? We need to look into that one. And before we start discussing the case, I just want to know your views about your views on what you see in this case. Would you recommend investing in the company, or would you advise not to invest? I want some input from your people. Are we connected, or I'm not able to see any chat or things? Yeah, okay. Bhupendra, right. Bhupendra, tell me, do you feel that we should go ahead and then invest money in this company? Do you advise? Okay. You said that it's better to wait. Okay. You wait in the sense that not to invest, because you have to take a decision whether to invest or not. So I go by your statement saying that it's better not to invest money on that company. Bhupendra says that strong revenue growth, therefore we should go ahead. Okay. Nagel tells we need to work out why the cash flow is negative first. Not to invest, we should invest. Okay. So some people say we should invest, some people say we should not invest. Some people say we need more data on that one. Okay. Let me okay. Let us now. Some of you said that why this cash flow is a negative. Cash flow from operating activity is a negative. Suppose if you pick up a typical cash flow statement, I already discussed in that one, where you see some plus and minus numbers. It starts with because most of them will give indirect method of a cash flow statement, where they start with the profit after tax, and then they will make several adjustments. I should zoom out or zoom in. So I think that, okay. Okay. Yeah. Okay. Let's take one by one. Now the issue is that why that cash flow from operating activity is negative. It is not possible for us to know why it is negative. If they give a direct method of a cash flow statement, then it is possible for us to figure it out why it is negative. Because since most of companies all over the world produces indirect method of a cash flow statement, except a few countries like Australia and Malaysia, their companies required to produce cash flow statement in the direct method. So from the indirect method, it is very difficult to figure it out why this cash flow is a negative. But what we know definitely is that the cash from the operation is draining out. It is not contributing to the business. That is what is clear. Whether you prepare direct method or indirect method, the final number is the same. So we don't have any idea on that one. We have to get indirectly this number. There are two primary reasons for cash flow to be negative, cash flow from operations to be negative. One is that you sell goods, but you are not collecting the money. So that could be the one reason. The other reason is that you buy material, more material, but you are not selling. So let's see that the receivables first. So we have a sundry debtors values are given here. I put those numbers in a Excel sheet so that we can start working. This is the sundry debtors. Now we can find out amount collected from customer. We can do that one. Amount collected from customer. So how do you do that one? We can't do it in the first year. We can do it from the second year onwards. Opening debtors plus sales of the current year minus closing debtor. So the amount collected from the debtors is 866. Let me explain again. This is equal to opening debtors, the previous year closing debtor is the opening debtors, plus the sales of the period minus the closing debtor gives you the value collection. And now we can drag it for the other period. Now we can know that this much of money has been collected from the customers. So our sales is at 3,692 and we collected 3,445, which includes last year period also. Last year our sales was 2,446, we collected 2,306. Therefore, it seems to be okay here. There seems to be no issue on amount collected from the customer. We can do one more thing. What we say is that I already computed receivables as a percentage of sales. So when you look into that, we have a sundry debtors 238. Let me just redo that for you. 238 is my receivables divided by sales. So this is 25%. And when you do it for the other years, you can see 42, 26, 24, and 23. So in this year, there is an increase, but after that it has come back to normal. So we say that one, on the sales side, things are going well. We are selling and we are collecting the money. Therefore, that is not the reason for having a negative cash flows, negative operating cash flows. Now, then what is the other reason? The other reason could be that we are buying more than our requirement. That could be the inventory would be the possible reason on that one. So when you look into that inventory, you can see this inventory data. Right. Now we need to work out what is the inventory as a percentage of sales. When you look into that inventory as a percentage of sales, they are all pretty high. We can't know how much of the purchases are being made. That number is not available with us because, or how much money is paid for the purchases. Because unless we have the cost of sales, we cannot do that one. Cost of sales is not given to us. Therefore, we need to indirectly work this value. What we now realize that this company is having a huge inventory value. Right? This is what we guess on that one. It's quite possible that the company is building inventory, very large amount of inventory is building up, and it's also making the payment to the farmers, and sales is not happening to that extent, and therefore we can say that one, the operating turns out to be a negative cash flows. So on the face of it, we can say that, look, this could also be a reason. But our concern is that how long this company will continue with this kind of a negative cash flow from operating activities. Who is funding this negative cash flow from operating activities? Who is funding this inventory increase in that one? When you look into the shareholders fund, right, there is an increase is happening, but not to a large extent, right? And a part of this could be attributable to the profit of the period, which is shown, but the profit is not in the form of a cash. So the shareholders have not brought any cash to the company. They are also not able to generate any cash through the operations, but the company is spending a lot of money to buy an inventory and incurring other expenses. And we find that the long-term loans are increasing from 2003 to 2,900 to 4,000, right? Not only long-term, both short-term and long-term. These numbers are increasing. This is a concern. They are building inventory only because of, or mainly on account of additional loan received from both short-term and long-term lenders. Okay. Is that clear? This understanding is clear at this point? Okay, good. Shareholders' point, what I'm trying to say is that one, there is no significant change in the shareholders' value here. The shareholders are not contributing much into the business. Whatever they have contributed, fine. They contributed only in two ways. One is that they bring fresh cash to the business. The other way is that they generate profit, not take that profit and leave it in the business. And when you look into that, the profit is there, but it is there only in the books. It is not there in the form of a cash. Right? When the profit is not in the form of a cash, for example, you can see this one. 123 is 95 is a profit, and 545 plus 95 is something closer to 600. So which means that whatever that is increased, 602 has become 900, which is primarily because of this 241. So there is an increase in the shareholders' fund, but this increase is purely an accounting number. There is no cash behind these increases. Whereas here, the cash is coming. The loan, the cash is coming into the business, and where that is getting used, they are used to build inventory. So they borrow money and buy inventory. Business is not generating cash, and the question is that who is bearing these losses, this cash outflow from the operating losses? There's a negative cash flow from operation activities. The loan also. Part of the loan is going for funding that operating cash flow, negative operating cash flows, and part of that is going for the inventory building. If this is clear, now let us move into the next issue on that one. How long this can continue? Is there any other reason, or could there be any other reason for this negative cash flows and huge inventory value? For a moment, let us assume this company is not doing well, right? Let's assume the company is not doing well, but they have a heavy loan. A huge amount of a loan is already there. If the company comes and tells to everyone that it is not doing well, what is the consequence of that one? What would happen if the company reports to the public saying that we are not doing well and they've already borrowed heavily? What would be the consequence on that one? Yeah, in case you are right, will not get loan to operating expenses. The lender will stop giving money. The lender will put a lot of pressure to get that money back, right? Investor won't invest money anymore is okay, but here the company anyway is not taking money from the investor. It is raising money only from the bank loan. So this is now the dilemma for anyone who is running this kind of business. They feel that it is not, money would stop from all directions. Yes, correct. So many problems will come, right? So I want to postpone my declaring that I am incurring a loss. So what I will do that one? What are the ways in which companies manipulate accounting to show that they are making profit? Right? There is also a possibility that lenders increase the interest rate, right? You know, there is also a pressure. But lenders won't increase the interest rate. They would rather insist that you pay the money back, kind of thing. Right? They stop giving money and then they will ask money to be repaid and other things. So this is how the manipulation typically starts. The moment you realize that by declaring you are not doing well, there could be other consequences, and therefore you want to show that you are doing well. So how can I show that I'm doing well? Actually, I'm not doing well, but how can I show that my company is in a healthy position? Here is a place the inventory valuation is typically done. Yeah, you are right. Unless the payment is paid, request for additional loan will not be approved. That as far as the interest is concerned, the company is still making payment. Because the company is having a sales, and the company is having some collection. We saw that there is a healthy collection is happening, so they are able to do that one. But after doing all these things, they find there is a negative number from the operations. And what they are doing is that these negative number operations, they are collecting money from the lenders to meet that operating losses, which means that they borrow money and then pay the interest, basically. Right? So now, the only option available for me is that to go and manipulate this number. If I have done this manipulation, then I will end up in having very high inventory as a percentage of sales. Now, in 2010, it is only a suspicion. It is not a confirmed story, because we don't have, as an outsider, any clue on how things are happening inside the company. But what we have an evidence is that this company is having a huge negative cash flow from operating activity, and it is increasing, and it is not consistent with the profitability of the company, which is showing a healthy picture. And what do you do that? You typically go and search in the annual report, are there any explanation provided on that one? Siphoning of the money, there are cases, but I believe that this is not visible here in this particular case. Here, there could be a potential possibility this company is not doing well, and to avoid an embarrassment, the company is trying to show a profitable company, and they might manipulate that inventory data. I don't have inventory, but still I'll show this is my inventory value, right? And then try to postpone the losses on that one. Okay. Unknown stop loss. Yeah. Now, we can't say, we need to now go and search the annual report of the company, whether there is any discussion that has taken place about this increasing inventory value. And if you don't find any increase, any explanation, proper explanation, then we have to now, we have to defer. Some of you said that we should not invest. I agree with them. Since we don't have any clue how this company is doing, the correct financial position of the company is not supported by the cash flow from operating activity. If you take up any company, you will find that if the company is posting a profit, this will also show a healthy cash flow from operating activities. Our doubt is if these two are inconsistent with each other, then this is what will happen. Okay, I will quickly now show, because we have the case fact only up to 2010. Therefore, we need to do a decision based on 2010. We cannot go beyond that particular period. Our decision now is that in the absence of any explanation available to us, because of inconsistency between the cash flow from operating activity and the profitability of the company, we decided not to lend money, or we decided not to have any lending relationship with the company. Yes, already the company is heavily borrowed, and by chance, if these companies are resorting to accounting frauds, we'll be in a deep trouble. That's what we say, and then we stay away from that company. Now we will go beyond 2010 and see what has happened to this company after that. Okay, before that, now you see this is the stock price. This is how the stock price of these companies are there. So pretty good, coming down here and there, right? But the company is showing a good number on that one. But if you look into that today, the company's stock price, just I will show you that what is happening today. That may be of interest to us. Stock price can be obtained from various sources. The one source which we have readily with us, I am showing that one. This is a penny stock now. 0.4 is the stock price now. Right. So that's how the situation is now turned. The company is in a deep trouble. Now let us go and see that numbers quickly. So post 2010, when you look into that, we see that inventory value. It is 3,240, 3,571, 3,746, going up every year. Suddenly has come down, then come down, and come down. And when you see the profit, this company was showing profit, very healthy profit. Even after 2010, it is showing a profit. Up to 2013, it was showing. 2014, it showed minor loss, and 2015, it declared that it lost heavily on that one. And shareholders' fund turned suddenly negative from positive. It has turned negative, which means that there is nothing available with them. Loan is now very large, and inventories have gone out. There is nothing is in the inventory, so the company is in crisis. Now, question is that last year we had 3,000. In 2014, we had 3,283. That's come down to 261, which means about 3,000 crore worth of stock should have been sold. Sold at what price? 1,855. So it doesn't make sense. I don't think somebody who sells commodity at a throwaway price, unless it is a spoiled commodity, that could be the one reason. But the other alternative reason is that this entire inventory figures might be an artificial figure, cooked up number, and we correct it here. This has been corrected now, and this company now suddenly showing a loss on that one. Okay. Now, is it possible? In 2010, we don't know, but we suspect. But when we look into that, it has happened actually like that. I just want to give a few minutes for you to react to this issue. So how companies are preparing the accounts is very difficult for us to understand. There are at least half a dozen places where they can just change some numbers here and there, and then they completely give you a different picture. Many of you might have heard the WorldCom issue. The US company called WorldCom suddenly has busted. So what is the reason? So the company, what it has done is that it has to receive money from other service provider. It inflated that value. It has to pay to other service provider some money. It understated that value, and then they started showing a healthy profit. But this cannot go on for a long time. How long this kind of a manipulation can go a long time? This all bubbles are making. It's very difficult. This bubble, the more the size of the bubble, it has to burst at some point at the time. Okay. One of you asked what auditors are doing. That's a very good question. So you go and see that audit report of companies. both in India as well as many other countries. Auditors will clearly disown. They say that it is not possible for them to go and check what is the value of the inventory, right? Because you think of situation that when the company says that I have 3,000 crore worth of rice with me, do you think that it is possible for anybody to go and verify and what is the value of this one? So auditors typically take a certificate from the company's management saying that they have done the inventory valuation and certify based on that one. Gokul, you are saying that there is a possibility of a massive wastage of holding a lot of stock. Possible, but it's not happening on that year, no. The problem is that if at all if this is happening, this should have happened over a period of a time. So your inventory cannot go in 1 year, everything waste. So which means that you have a chunk of spoiled stock, but you are still showing that they are good, and then doing the valuation, increasing the valuation, right? And now suddenly you find that it is not possible to continue this one, and then you declare at that some point of a time, and then you show a huge loss of that year. No, there is no change in the valuation of inventory method. So you are talking about are there any changes in the valuation of inventory method? To my knowledge, there is no changes in the valuation of inventory. And no one will do a valuation of a change in the valuation of inventory to show a loss, right? So this loss, assuming that it is this much of a large loss will not happen in the first case by changing the valuation of inventory method. Even if it is true, no one will do that one. Why somebody should do changes in the inventory valuation and show a loss? Okay, the consolidated group financial statement, which is not required here because these companies are not having much of a subsidiary companies and other things. So anyway, we most of our analysis on standalone basis, unless we believe that there are group companies which are associated with that one. In this case, at least in RE Agro case, there is not much of a subsidiary companies which are in the picture. Okay, now the case primarily highlights, let's not go too deep into that post-case scenario. I just want to highlight the fact that in this particular case, our suspicion turned out to be true on that one, right? So the first thing which we need to do that, we need to look into that whether this profit are consistent with the cash flow from operating activity. How much of a profit also realized in the form of a cash? This is what we now need to look into that one. For the benefit of everyone, I'm going to take one the old case. This is a company, some of you may know, many of you may not know. It's called as the Maitas Infrastructure Company. It is one of the companies of a Satyam group company, which is also a listed company. And many of you know that what has happened in the Satyam case in India. It is Satyam is the equivalent of Enron and WorldCom related kind of a situation as far as India is concerned. And now you can see that one. This company said that, I have 109 crore profit and it has gone to 240. And when I do some adjusted accrual profit, it has gone from 75 to 167. But when it comes to the cash flow from operating activity, it has moved. Both here it is a negative and it has increased. And the end of the story is the same. This company is also collapsed, and those who invested money lost heavily in this company. So we have enough evidence today to demonstrate that these kind of things are happening. Okay, you want to know what can we do the same analysis for Enron? We can do, but you will not. But you, I see to say that you are not able to hear me, right? I think others are hearing me. I'm not sure. We are also monitoring here. Okay, let's come back to that Enron. You can do that in Enron case also. You can pick up the Enron company's annual report and then compare cash flow from operating activity and to the profitability of the company. You will not find any problem there. The reason is that Enron is a profit-making company. It's a good company. The business is doing very well. There's no issue on that company. And cash flow from operating activity is also decent. There's no issue on that one. But in Enron case, what has happened, this company started giving some kind of a guarantee off balance sheet. There are a lot of liabilities which have been created outside the balance sheet of the company, which are not reported in the balance sheet. And one fine morning, you get all these liabilities come on front of you, and then company collapsed. So a case when okay, the case with Enron is that it is not possible. The problem is not from the business side. The problem is a few people associated with the company started doing things outside the company. Particularly, they created a lot of a limited liability partnership, and they have taken a huge exposure, and all of them finally resulted in a huge loss. And all these guys have played in the derivatives market, which is not reported in the balance sheet of the company, because the company has not much of a derivative transaction. Most of these associated companies have done the derivative transaction, and the company is actually indirectly taking the responsibility of those transactions, but not reported. And suddenly one day it has come, the company collapsed. Whereas if you do this analysis in the WorldCom, you will get that exactly. Because the WorldCom was not doing well, but to meet the analyst expectation, what we call the Wall Street expectation, this company started reporting a huge profit, and that collapsed on that one. I'll show you another company called Bush and Steels. There's another Indian company where a lot of the police cases, CBI cases are going on this company. Because this company is also borrowed heavily, and then one fine morning they said that they lost business on that one. We can now check that this company, what's happening on that one. You can see here the profit part of the company. We'll take profit before tax. When you see this, you see a very healthy picture. And all of a sudden, you say 2014, you collapse. And you collapse. You pick up some other company like a Tata Steel and other kind of a company, you don't see this kind of any problem. Whereas Bush and Steel suddenly collapsed in 2014, and then 2015, 2016, the company is reporting a huge loss on that one. So what has happened to this company? If you look into that, again, the story is that the inventory. Huge inventory is getting built up, and we don't know what is the value of this inventory. When you look into that net cash flow from operating activities, you will see that a lot of inconsistencies. For example, in this year, 560 has become 1,151, whereas here 536 has become 397. The number itself is a small and it's going as a negative. And you come here, you suddenly show a negative cash flow from operating activity, whereas you show that your profits are intact. Previous year you showed 2,851, and this year you showed 2,207 negative. So what is happening is that probably this company's actual profitability is like that. What does it mean? Wide variation in the profitability of the company. One year the company is doing very well, the other year the company is not doing well. They are showing a lot of fluctuations in this one. But I don't want to go and report this to the world. I want to smoothen my profitability of the company. So what I do that, I will go and do some manipulation on my inventory and then try to get a very smooth, healthy profit for me. So when I look into that, this looks very healthy, right? So this profit is increasing steadily, right? And then it's going up. But suddenly it has come down to a negative number on that one. When you look into the sales, you see, I show a healthy picture on that one. So the point which I am trying to make is that cash flow statement is a very important statement for us. This is also prepared by the company. This is not prepared by us. This is prepared by the company. Profit and loss account is also prepared by the company. And they know that profit and loss account is what many people will see. Whereas this the cash flow statement, people may not see much. And that's the reason the whole focus is to manipulate the profit and loss account. Cash flow statement, they cannot do much of a manipulation, so they need to report the same thing. If you find these two are not correlated with each other, then we need to stay away from those kind of companies. Now you can see in the Bush and Steel case, so you can see how much of a debt, this is a level of a debt, right? And when you look into that, many banks are now suffering in India because of these kind of companies. They borrowed heavily and suddenly they all say that they are incurring a loss. And when you see the shareholders fund, it's just only 4,000 crore. So what they can do, where from they can go and recover these things? It's very difficult. And you just go and see in 2017 data, I have not put that one. By now you know that at least a 3/4 2017 data is there, and this is also wiped out. This this number is also wiped out. 4,700 is not there. Now it is a negative. This company's net worth is a negative now. So the shareholders lost everything. It is only running with the debt fund this company is running. Okay. Financial statement with made up numbers makes entire analysis worthless. The answer is yes, but if this company is also reporting a good, healthy operating profit, I won't say that this financial statement are worthless, right? So we need to be clear. I won't say that every company in the world is the governance is very poor or they are doing this kind of a thing. So we need to be careful when we analyze what kind of things included in inventories. Typically, the inventory consists of raw material and finished goods. These are the two items which are forming part of the inventory on that one. In the RE Agro, there is no raw material. There is only finished goods. In fact, this is a trading company. Primarily procure rice and keep it for a few days and then pack it and sell it. Whereas in the case of Bush and Steel, you have both the raw material as well as the finished goods. We don't know where the manipulation is happening. So there are half a dozen ways where companies will do this kind of a manipulation on that one. So we have to be very careful in analyzing the profit and loss account. Before we start doing any further analysis on the profit and loss account, we need to check whether these numbers are consistent with that one. I'll show you one more company. Again, some of you may be familiar with that one. The Bharti Airtel is a company, it's one of the largest players in India, the telecom space. And Reliance Communication is also another company which is on the telecom space. When you look into the Bharti Airtel, you can see that their adjusted accrual profit, this is coming from the profit and loss account, the income statement, is 6,604 and it is 8,000. Cash flow from operating activities 8,000. So 6,600 has gone to 9,000. The company says that we are doing that. And cash flow from operating activities also increased from 8,000 to 10,000. So that seems to be what I would say is consistent. You show a profit and you also show a profit in cash form. It is the profit is supported by the cash. And you come and see here. You see, in 1 year, you have a profit of 4,452, and your cash flow, you say that it is like 10,000 odd. Next year, you say that you are healthy, you are able to maintain that one, but your cash flow from operating activities at 2082. How can we explain this kind of a variation in that one? Wide variation in cash flow from operating activity and profit statement. This is the concern. So there may be a company, if you take up 100 companies, maybe about 5 companies or 10 companies or 20 companies, depending on the country where from you are, there could be a possibility of this kind of a manipulation. The remaining 60, 70, 80 or 90 companies may not do these things. So how do we know as an outsider is the only way for us to know that we ask a simple question, whether profits are supported by cash. If we say the answer is yes, we can go ahead and then trust these companies and then proceed further analysis. If we say that one profits are not supported by cash, then we need to be cautious. I think with this, I am closing this case. We will move to the second case. That's a relatively small case. We will quickly run through. But if you have any question, I will take the question if there is anything related to this case before I wind up this discussion. Any question from any participant? Okay, great. Okay, Saran, great. Let's move further on that one. I think that's what we explained to that one. These companies, there are two primary things they manipulate. One is that revenue. I can actually create a few invoices and then create a revenue, and there's nobody there. And later on, I reverse that thing, saying that I receive back whatever I sold. So sales entry, sales return entry is a very standard way to manipulate. Second is that inventory is the second way to manipulate. These are the two dominant ways in which the profit statement can be manipulated. Net cash from operating activity is not cash on hand. What it says that one, it is a difference between amount collected from the customer than amount spent on operation related activities like paying to supplier, paying to employee, paying to in the form of cash, and then find out how much of the net cash I generated from the operating activity. This is not necessarily in the form of a cash in hand. Of course, if they are not spend that money, it will be in the form of hand, in the cash only in that one. Is it only manipulation? Possible. Yeah, if the company is incurring a loss, the share capital value will become negative. Yeah. Okay. Let's move to the second case. This is fairly simple one. This company, Tata Motors, many of you may be familiar, even from outside India. So they have incurred a loss in 2014-15, which is not a good year for the company. Now we have the balance sheet of the company for 2 years. Using that, the question is that can you explain how this loss was funded? Who provided money for this one? Right. So we have the data. Let me go to that. Here. So I just pull the data in the Excel sheet so that we can work on that one. A simple way for us is to make we can compute the difference between the 2 years and then see how things are happening on that one. To get a further insight, we are not now looking into that any unethical practice of Tatas. Yes. Generally, the perception is that Tatas are more ethical company. The governance is pretty decent and good, and therefore we are not getting into this the one which we discussed in the previous case. Now let us find out the difference line by line item, how this is happening. We'll do the same thing here also. Okay. So what we have done is that we picked up the 2015 balance sheet data and deducted 2014 data to get this one. So now we can see how this loss is funded to that extent. There's a minor difference between the loss shown in the case and the loss shown here. That is because they have a few other losses which they have reported in some other head. They transferred actually. After making the accounts, they transferred that kind of losses to other heads. That's the reason. But that numbers are very small. So let's not worry on that one. Let's see the substantive part of the case. A part of this loss is funded by the lenders. They borrowed additionally 2,573 crores to meet this loss. That's one reason. They have also made incremental provision. Provision is basically a future expenditure for which they have not paid that money, so they defer. Right. So that is another value which is seen on that one. Going from the current liability side, they also borrowed 2,993 to the short-term borrowing, and these are the provisions they postponed that one. So if you look into that, totally they got 2,000. The primary two sources that 2,593 provision, and then another 2,993 is one source of the funds they generate to meet the loss. This is on the liability and equity side. Let's go to the asset side. This year they have not invested much. They invested only 228 crores. Very small amount they have invested. Whereas they sold some of their investments and then converted them into cash. So this will also go for funding the losses. And here when you look into that, they have increased inventory, which means that along with the losses, they also need to meet that the inventory amounting. All put together another 1,834 they have spent on the current assets, basically. So now we have some basic idea. Now let's try to put them together and then see how this is happening on that one. We'll start with at a macro level working rather than getting into micro level. So we have some 4 or 5 broad headings are available. Through that we can see that one. So we'll first look into that, the asset side. So what we get from investment, funds received from investments. The company sold investments and generated this much, 1,625, right? So this is the amount they generated on that one. Let me just put the minus number so that we don't look at it. This is the additional amount they spent. Additional investment in fixed assets. So they spent another 228, right? Additional investment in current assets. Right. Net balance. Net balance is a negative. So they got 1,625 by selling some of the investments. They invested additional fixed asset of 228. They also invested another 184. So the 437 is the negative number which they have on this side of the balance sheet. So in addition to loss, they need to meet this also. They need to fund the loss. They also need to fund increase in the assets. Net increase in the asset side is now 437. They need to meet that one. Okay. Let's see this side. So what are the ways in which they got money and how they have spent on that one? The first thing is that funds from long-term loans. So they got totally non-current liabilities, all put together is 2,950. They got that money. Funds from current liabilities, which includes short-term borrowing and all put together. Ultimately, they got another 1,573. And together, they got this much. Less losses. Because they use a part of this for the losses. The losses are 4,314. Yes, the numbers have come down. So I can just put them as minus number. So what they have is 209 is what they have surplus. And this surplus has gone here. Let's quickly see whether we made any mistake here. Let's see whether these numbers are correctly added up. Yes. So, okay, this is correct. I think we have done a mistake here. This 228, it is correct. So this we have to add only this much. This is 1,853. Okay, 1,853 is the funds retired from investments. From this one we got, these three we got, and then we spent 228 out of that, and then we spent another 1,804. So all put together we got 209 as a negative number this side, and here we received through loan, through funds from current liabilities, we got total losses of this much. So to answer the question, how this company has funded the losses, it is not, the loss is not coming, the loss is not funded from this side. Where this, on the asset side also we need to put some money, where there is a net increase in the asset value. A part of that increase is funded by way of selling some of the assets which are lying with them, idle. That's some investments are lying, some cash is available. They might have closed some of their deposits and then realize the cash, and they use that to build some of the inventory and other things. But still this side, the operation, the asset side also requires 209. So we'll keep that one. So that's what is happening here. So primarily the lenders have given money, 2,915. Another lender, the short-term lenders are also given another 2,993. So together they got about nearly 6,000 crore rupee they got through the loans. And current liabilities, some changes which are happening here. So that is also taken out. So net to net, to answer this question, the company is just survived only with the lender's money. The company has not brought any equity. Equity remains same, right? When the company is having so much of a loss, there is no equity funding is happening. The funding is happening through the loans. Now, this is in many cases, this is a starting point for trouble. When the company is not doing well, if the equity holders not willing to put money, and started depending on lenders' money or suppliers' money, it's also possible. There's also, if you look into that, in this case, it has not happened. Trade payables are actually come down. In many of the cases, you will find that the trade payables will increase significantly. If you start expecting others to fund your losses, loss is not a small amount. Loss is a very large amount. 4,000 crore rupee loss is not a small amount. If I have to translate it into in terms of dollar, it is something closer to that $0.6 billion, right? So, which is roughly about $600 million loss, which is not a small amount compared to the size of this company, right? 4,000 crore loss is not a small amount, and the shareholders are not willing to bear the losses. They don't want to pump in any money, but expect the lenders to pump in that money and then run the business. This is potentially a starting problem of most companies, and if these companies sustain this kind of a behavior for some more years, then you see a major disaster might happen for this kind of companies. So what we now come to the conclusion from this case is that in this small exercise, it's not even a case, I would say it's a small exercise. Our conclusion is that Tata Motors in 2014-15 incurred a loss. A substantial part of the loss is funded by the lenders, long-term lenders and short-term lenders. And this company requires some amount of additional investment in current assets. There's a fixed asset investment is not happening. And they are able to get that money by selling some of their investments. And owners have not put any additional capital, and they're trying to run the business. Therefore, we are worried now, right? Will it sustainable? That's what the case is trying to say. Okay. The long-term loan on assets is that to the directors. I'm not sure what is that you are asking. Long-term loans. Long-term loan assets. Long-term loans and advances. Okay. This need not be to the directors, right? The long-term loans and advances on this side, this is coming here. It could be for the other companies, the group companies, right? That's one possibility. It could also be maybe when they buy some equipment, they may give advances. So it's typically it's a group company, the other companies to whom they give money. So Tatas have a unit in the London, there's UK, somewhere in the European country, and this company would have given some loan to that company. So it's basically the group company entity. Yeah, they are loans given to group companies. If you go back and check more details, the schedule, you will get more detail about how much of them related to the subsidiary companies, how much of them related to associate companies, how much is related to pure outsider. All these things you will get that one. For example, if they paid money to the power utility as a deposit, that will come here. Right? For example, Tata Motors, they have a huge electricity requirement, and if they paid a couple of crore rupees as a deposit with electric utility authorities, that will also be part of your long-term loans and advances. So many things is possible on that one. Okay, the core part of this one is that when the companies are incurring a loss, we expect that the shareholders should at least contribute part of this money. Relying exclusively the lender's money is something which the company should avoid, right? So this will potentially come up as a bigger number at some point of a time and become totally an unmanageable number on that one. Okay, great. I'm stopping this particular discussion on that one. Next week, definitely our case is going to be much bigger. Next week is basically the core of this particular 3-week module. where we are going to get into more of a financial statement analysis. We have a very nice template, etc. has been created, and by Thursday you will get all these details, and you can start working on that one. And I want all of you to actively participate in the discussion forum. So far, the discussion forum is a bit inactive. People are just introducing themselves and what is they're doing, what they're expecting, and other things. But we also need to put some learning part of that one. Hopefully, I think that first 2 weeks may not be the right time, but at least the third week should be the right time for us to do a lot of activities in the discussion forum. Okay, thank you. I'm closing. If you have no other questions, we will close it down.